financial reporting and accounting update has been one of our tried and trues, and I know we all look forward to hearing from our panel each year. This go around, we have Carlos Bravo, a partner in audit services from RSM, who is going to be the moderator for this discussion. I believe you have a very lively group. Should be an awesome discussion. I'll ask Carlos to introduce himself and his panel, and then we'll kick it into gear. Take it away, Carlos.
Thank you. Thank you very much, and good morning, everybody. I wanted to thank everybody, including the panelists and for allowing me to be here moderating. It is an honor. So, as a brief introduction of myself, I'm an audit partner in the I'm located at the Miami office for RSM. Been in public accounting, I would say, more than 23 years. Started at the Big Four. I currently serve SEC companies registering from large accelerator filers to small reporting companies, not just in South Florida, across the U.S., Latin America, and the Caribbean, for that matter. So again, pleasure to be here. So with that being said, I'll ask Sylvia as a first panelist to introduce herself.
Good morning, everyone. I'm sorry that I look like my panelists told me that I look like I'm in this matrix. And I am on the West Coast, and it's still dark out. But I'm very, very happy to be here with my alma mater. I graduated from the law school. I won't tell you what date, but I graduated from the law school many years ago. Just by way of a brief introduction, I started my career in law in Miami. In international matters, went in-house, and while in-house with Chevron, in the midst of a pretty significant corporate crisis, I was asked to move from the legal department into the business area of the company to lead our corporate responsibility. And that's where I've been since the beginning of 2000. Currently serve as the Senior Vice President and Chief Environmental, Social, and Governance Officer for the Royal Caribbean Group based in Miami.
Well, thank you, Silva. Rich?
Good morning, everyone. My name is Rich Good. I'm a partner at Alvarez & Marsal, professional services firm, and I'm one of the leaders of our ESG services practice. Prior to my time at A&M, I worked for EY for about 10 years. I was also in our ESG services practice there and helped found and build that practice over time. But prior to that, I was actually in industry. I was Chief Sustainability Officer for a company called Lucent Technologies, later became known as Alcatel-Lucent. So I've taken ESG from both sides of the fence, both from the client side as well as on the professional services side. And while I didn't go to UMiami, I am an adjunct member of the teaching faculty at Harvard University, where I teach a class on supply chain, ESG in the supply chain, as well as greenhouse gas emissions. I'm happy to be here with you today.
Awesome. Thank you, Rich. And last but not least, Jess.
Good morning, everyone. My name is Jess Dow. I am a director in PwC's ESG practice. So I have been with the firm for 11 years, 10 of which were in sustainability. I had an accounting and engineering background from Lehigh University and started actually in audit at PwC. Then I found my passion with the sustainability world, and so moved into our sustainability group at PwC about 10 years ago. I focus on helping companies at the beginning, especially assuring ESG information. So some of the big clients like Tiffany & Company, Etsy, Johnson & Johnson, where we assure their financial statements, we can also assure non-financial metrics like diversity, carbon footprint, any of those types of non-financial metrics. I was also able to, in 2017, work in Amsterdam for a year with GRI, the Global Reporting Initiative, and the United Nations around how businesses should be responding to the SDGs. So that was a really great experience. I came back to the US after that year-long project and now focus on both strategy projects, how to move forward clients' ESG agendas, and think about different decarbonization activities and aspects that they can implement into their programs. So looking forward to the discussion and hope there's lots of questions from the group as well.
Thank you, Jess. Well, as you guys see, we got plenty of thoughts here that we can share with all of you, and we hope this session is very meaningful and kind of tickles your brain as to what we believe it's in the infancy of for some regulatory aspects of it. So I guess I'll ask the first question. I guess I'll start with Jess now. So as part of the introduction, to the financial reporting topic itself, which is what we're talking about here, because we all know environmental, social, and governance can be a very long and broad topic. But what does it really mean when we say ESG, and how is it impacting businesses every day now in today's economy?
Yes, so ESG is so broad. I think we can look at the spectrum of different ESG topics and it's completely overwhelming. One of the first things that we really do with our clients is to think about what is most impactful to your business. So if you are a brewery, water conservation or water use is a very important metric for you in terms of ESG. If you are a chemical company, waste disposal and managing hazardous waste, that's very important. So I think there's a great starting point where you first start to look at different environmental and social topics and think about that broad universe. Then you think about what's impactful to your company and where you can really make a difference. And that's the best result of thinking through ESG is how do you tie it into your business strategy as a company so that you can move forward and collaborate between the different ESG departments, finance teams, and the executives within your organization.
Yeah, thank you, Jess. I guess, Sylvia, you should have quite a bit of story around this in your business. So would you mind sharing with the group what does ESG means to you and the economy and how is impacting your business precisely?
I think Jess has very well described what ESG should mean for companies. For the Royal Caribbean Group and for any public company, really the starting point is conducting a materiality assessment. And that materiality assessment looks at the issues that are important to all of the company stakeholders, not just investors, but civil society, employees, business leaders, academia, etc. And you plot them against issues that are impactful and to the business and impact the financial and operational performance of the company. Once the company has a good sense of which issues are material, those issues are framed the way the company reports annually and throughout the year to its stakeholders. But it's important to note, Carlos, at this point, when I say material, and this is something that is a subject of constant debate and clarification, I'm not using the word material in the context of SEC materiality.
I was just gonna, okay.
Yeah, it's important, and there are some issues such as climate change and human capital, as the SEC is now signaling, that may fall into the realm of SEC materiality. But important in the ESG realm does not necessarily mean material in the SEC realm.
Interesting. That I'm sure that's going to have an impact also eventually how the SEC will evaluate, how companies are doing it for sure. Rich, how about for you? What does ESG mean to you, and what can you share about your experiences with impacting businesses in today's economy?
Sure. So I don't want to repeat the excellent answers Sylvia just gave. I guess maybe I'll take the answer from a little bit of a different angle, where when I look at the state of ESG reporting, say among the Fortune 1000 today, some of the largest companies out there, and I look at all the work that's been done, whether it's called corporate responsibility, sustainability, ESG reporting, and all the amount of work that goes into that. The thing that strikes me is all of that so far, at least here in the US, is voluntary. There's no real regulation that says thou shalt report on these issues, or as Sylvia said correctly, starting off with a materiality assessment. It's all been done voluntarily, but businesses only do things when it makes sense and there's a business case for it. So we have to take a step back and look at the stakeholders. And to me, it's the stakeholder groups that is really sort of an interesting conversation and how that's going to change over time. The stakeholder groups have largely been, I sort of follow the 3 C's: customers, cost, and competitors. So you can, look at your business through a lens of sustainability, reduce your costs, have some innovation, please your customers, keep your competitors at bay. But now it's expanding. And, I think where we'll end up going with this around the investors as a key stakeholder, where they basically said to businesses, we don't care whether or not you believe in climate change. We're seeing, material in the true SEC sense of the word impacts to our investments. And we want to know, are you at risk? So I take a look at this more from the key stakeholder perspective and how it's changed over time. Because I know just in my role in professional services, for the first 5 years or so in professional services, we're lucky to kind of get a meeting with maybe an investment manager. And now we're typically talking to CEOs, CFOs, and general counsel in every single engagement.
Yeah, Carlos, if I can note one thing, I think Rich has brought up an important point that there's really a paradigm change. When ESG reporting started, it wasn't even ESG, it was corporate citizenship, corporate responsibility, corporate social responsibility. And back then, companies largely did this feel good, this is the good that I'm doing type of report, where it was not necessarily greenwashing. The company was still reporting issues that were important to them, but they were only giving really the positive perspective of their operations. Once globalism and multinationalism proliferated, along with the speed of communications, and multinationals their operations in remote and emerging markets were put on the spotlight, and what they were doing in Myanmar or in remote places in Africa became public. There was a focus on company impact. So reporting then turned into, this is how I'm managing my human rights, my social and environmental impacts. Then the paradigm changed to, hey, we're not only interested in your impacts, we are interested in how this company is contributing to societal progress. And that was largely prompted by Larry Fink's Dear Shareholder or Dear Issuer letter, basically saying, your financial performance is important, but we also want you to know how you're contributing to societal progress and on important issues like climate change. And take it to one step further, which Rich was alluding to, now there's a convergence of, and regulators are looking at and comparing regulated and non-regulated reports to say, okay, if you're disclosing XYZ on your ESG reports, why are you not disclosing the same in your regulated SEC reports?
That's interesting, because it was almost, and that's sort of that's a great point for the next question. I myself as auditor, when we opine on financial statement, we go by a framework, right? For purposes of internal control, we have the good old COSO framework that I'm sure the audience knows about. And also, as far as accounting principle goes, the auditors, when they perform attestation, it's either US GAAP, IFRS, or whatever the framework of accounting the registrant has in the case of an SEC or non-SEC for that matter. So I guess I'll point this question to Jess, because I know she mentioned she's worked on some assurances around this. So I guess how would you categorize or mature is the framework around ESG? Because absent of a framework, it almost sounds like companies may pick and choose what sounds better, right? And not really dive into the completeness of what the impact is. So Jess, right, how would you say, how mature is this framework, if any, or are companies adopting one just by consensus?
Yes. And there's probably kind of two elements to that question. I think from the first side, when companies are reporting on ESG topics, there are a variety of frameworks that they can choose to report on, such as GRI, that Global Reporting Initiative, SASB, the SDGs, WEF. So companies can choose those different frameworks, but at this time in the US, it is completely voluntary reporting. So it really is up to the company to make that decision based on their key stakeholders and their ambition internally to decide what is their best path forward and what resonates well with their stakeholders. We are in the US seeing companies use SASB much more. So the SASB has specific metrics for a company's industry. Those at least can be comparable across the industry, which is very helpful. Or companies are still using GRI, particularly if they've been reporting ESG topics for a while. So that is great, I think, if a company is relying on some frameworks that are better established, that have certain definitions behind what these metrics mean, so that there is that consistent criteria and definition. From an audit perspective, when we start working with clients, that audit angle is also completely voluntary. There are very few industries that have any type of regulation over ESG metrics. Maybe some utility companies might have some energy requirements, but usually if a company approaches us asking for assurance over their carbon footprint, that is just because they want an independent third party to review that data and attest that there is nothing materially wrong with that information. So they're able to also kind of dictate to us what that scope of work is. So we've worked with clients, yes, we've worked with clients where we might just assure their scope 1 and scope 2 greenhouse gas emissions. I actually had a conversation this morning with a company who's interested in us just looking at their scope 3 product use metric, and to start looking at their methodology and thinking if that makes sense, and maybe we can point out some improvements that they could make. That is up to the company right now. We absolutely do challenge companies if they come to us and request that we would only look at their diversity metric, but only the number of women in this one region. We might say, wait a second, why aren't you looking at a more global picture? Why aren't you thinking about this from a different approach that captures and tells your story better? So we'll absolutely challenge that, but it is still in kind of still early phases. But I will say we are having more conversations as well, companies coming to us thinking about integrated reporting, which is more of what we see happening in Europe, where ESG metrics come in with the financial metrics into just that one integrated report. So that is all starting to shift because we've seen this great ESG reporting evolution over the last, especially 2 years, I would say. So hopefully we'll continue to see momentum.
Interesting. Rich, what would you say around that question specifically? It sounds like people can, again, companies can pick and choose, and kind of like kids when they tell their parents they're good grades, but they don't tell them they're bad grades, right? So if there's no framework, what's stopping me for only making public, the good grades, right? So, Rich, what are your thoughts around that, and the hopes that this might change in the future?
Sure. So Jess is right about companies being able to pick and choose because it's voluntary, and why not start with something you feel good about your system of internal controls over, the quality, accuracy, and reliability of the information. There's another reason a lot of companies go for assurance too, which is for points, CDP points, DJSI points, and certainly understand that. And there's also a bifurcation where there's sort of the two types of there's limited assurance and review level, examination level, or reasonable, but there are also the type of standards. We're using AT 101, a test standard, versus something a little bit easier. So there are a lot of smaller boutique companies out there that perform audit services not to the AICPA attest standard.
Right.
And my view is over time, particularly with whatever the SEC may do later this year, early next year, is identify a few common metrics and suggest or mandate that they be assured, but in line with the same standard as your core financials, which means you can't hire an engineering firm to assure your carbon footprint anymore. You'll have to have your independent auditor do that, and have them do that to the higher AT 101 AICPA standard. So I look at some of the reasoning, and see that evolution coming over into the core financials. And Jess brought up a good point about integrated reporting, just having them together. But a lot of companies, if you do pre-assurance services for companies, which I've done a lot of, and I'm sure Jess has too, the internal system controls the quality of the data. It just wouldn't stand up to a Big Four audit. So I think my view is it's fine for companies to continue down this path. But I look at sort of the core indicators, and there was an article in the journal yesterday about the core ESG indicators. You have greenhouse gas emissions, renewable energy, diversity, perhaps at the board or employee level, and maybe worker safety. So the core ESG metrics that are common, I call them usual suspects. No matter what your materiality assessment says, that's going to be on there, those core metrics. Getting more comfortable with having them hold up to an investment grade assurance. It's one thing, and it's always a good idea to start with your own internal audit folks. They're a good, friendly place that you can ask them to kind of look at this data and help get ready for that examination level, because it's sort of like Christmas. This is coming for sure. So sure. Best to start to get ready for it today at the level that you're going to need to pass an examination level audit.
Oh, great, thank you. Let's see how now we can bring this down to the financial reporting itself. People think it's just purely disclosures, right? Yeah, like we see the news, Amazon said they're going to reduce their, pollution, fossil fuel, whatever, by X by Y year. But what does that mean beyond just disclosure that, right? So as we look at whether it's SEC, US GAAP, or even the FASB, actually, I think the FASB is in the process of proposing more disclosures about supply chain contracts and so forth, which directly or indirectly may have something to do with this or not. I just don't know. But perhaps I'll start with Sylvia. How do you see this really impacting beyond the disclosures into your balance sheet or the estimates that you have for that matter?
Okay, well, just on a side note, because it was haunting me, I was looking at Jess and I say, who does this woman remind me of? And I'm happy to report that she reminds me of Ann Coulter, but she's the nicer, kinder, and gentler version of Ann Coulter. And I'm happy to be with her on this panel. But on Rich's point on this is coming, this is what we are really looking at, not just with respect to reporting, but beyond reporting and why. So, the SEC and the US market has generally taken a very, like everyone has said, a very voluntary, laissez-faire approach to reporting. But the SEC has signaled already that it is looking at regulating disclosures around climate change and human capital disclosures. It's also set up a task force on ESG. And I think a lot of public companies have received recently a Dear Issuer letter. Please explain why your sustainability report says X, but your 10K says Y. So they are looking at this, and it really behooves everyone, like Rich says, to prepare for this. On another front, the EU is working quite broadly and quickly on regulating EU disclosures also. And while it generally applies to EU listed companies, there's a question as to whether those regulations will apply to US companies with EU subsidiaries. And they are looking at disclosures way above and beyond climate and human capital, and looking at a broad spectrum of ESG issues as well as management issues. How we're managing impacts, due diligence, what policies you have, et cetera. And then the third front area that we're looking at very deeply that goes beyond reporting is board oversight on ESG issues. We want to make sure that our board, as well as board committees, are looking at those ESG issues which pertain to their remit, whether they're in the governance committee, the audit committee, or a sustainability committee. But it is clear that there's an expectation that the board have oversight on these issues, and we're seeing that it's impacting the annual shareholder meetings and proxy season voting, where those directors are either voted out or, as we recently saw with Exxon, certain board members were integrated into Exxon's board with ESG expertise. So board oversight is key. In the past, board oversight on any issue has been driven by in a shareholder-centric manner, and now board oversight has to be much more on a stakeholder-centric manner, looking at a more holistic view on how ESG impacts the financial performance of a company.
For sure. Thank you, Silva. Jess, you mentioned earlier you've done some work around this. Me as an auditor, let's say, a company has a derivative which is including forecasted transactions on fuel, like you would see that perhaps on an airline for that matter. But at the same time, they turn around and they're announcing that they're going to reduce their fuels. And not that I want to get into the derivatives in this panel, but it does impact on the probability whether you're going to use the fuel you're hedging or not. So what have you seen with regards to any work that you've done on major companies? Are they linking whatever decision they're doing into the ESG into the financial reporting itself?
Yes, so we are absolutely having many more ESG conversations with the finance group at the table. That's a big shift from 5 years ago, where we might meet with a sustainability manager on their own. And now we are speaking with the controller, the whole financial team, potentially the CFOs involved as well. So I do think that bringing that full group together for these ESG conversations helps with the ties. Also, from an auditor perspective, if our team is the auditor, the financial statement auditor for our clients, of course, there's a very strong connection with different financial folks within an organization. So we're able to look at different efficiencies and links in the organization much more clearly, and then help make sure that we can establish those different impacts as we pull different levers from an ESG strategy perspective to tie to the business.
Awesome. Thank you, Jess. Rich, any other examples on the financial reporting impact that you can think of what you have worked with? Or
Sure. So as people have pointed out, just the level of conversations, and even when I was in industry as a chief sustainability officer, I didn't report to the CEO. I was a couple of levels down. That has really changed, and I'm seeing it more often up in the CEO, CFO range. And as Jess points out too, most of the conversations are the CFOs or at least chief accounting officer at least involved. The conversation has kind of gone from, I sort of call it the stages of grief, right? You have to go from shock, denial, anger, depression, and then finally acceptance. And that's what the CFOs have to go through, that ESG is coming for your 10K and your financial statements. So I've used that to diffuse some tense conversation with CFOs before. There are some companies that are trying this, and Sylvia brought up a great point that I totally forgot about, how the SEC is looking to say, well, you say these issues are material in your sustainability report, but over here I don't see any of the same listed. What's the linkage? And I think the WBCSD did some work a couple of years ago. They said that the amount of companies that have true linkage between their ESG and their financial report is only about 8%. So there's a long way to go. And then, of course, there's sort of the annual climate barometer that EY, when I was there, was putting out, that kind of showed the companies have an awful long way to go. The sort of the quality and depth of reporting of material ESG topics, really has not fully become embraced, because I think there's a lot of a lot of sort of angst, really, and still maybe people stuck in the denial part of their stages of grief, that you could actually provide assurance over these sort of metrics But really, when you look at it, a lot of them are very, very quantitative. Greenhouse gas is quantitative. Certain diversity statistics are quantitative. Worker safety, quantitative. And one thing I know, criteria loves to have quantitative things to work with. So this is very doable. And again, hearkening back to the stakeholders, I always ask, well, why are we doing this? Whenever a client calls me first and says, hey, we need to calculate our carbon footprint. What can you do? How much will it cost? It's like, well, let's have that conversation second. Who's asking for it? How are you going to use it? And I think the same sort of philosophy can be used in financial reporting of non-financial metrics, which is who's asking for it and how are they going to use it? How can I structure my internal system controls, data reporting, collection, and assurance in a way that's decision useful for those stakeholders, rather than just doing it to do it.
Absolutely. Absolutely. Thank you. So let's go. We talked a little bit about, the financial reporting, not just disclosure, but perhaps, items that might be on your balance sheet that you need to consider for these, programs and so forth. But when we look at operational risk, right, everybody's talking now about supply chain. And perhaps, Sylvia, I'll ask this question to you because I know you probably have dealt this with before. Is it going to be a point that companies, it's not just about what I'm doing, but also about the people that I am engaging with as a vendor? And if so, how far is that reach, directly or indirectly? I don't know if you've seen any program around that where, I'm just requiring my vendor to have certain standard, no different than we do for cybersecurity.
Absolutely. All ESG standards and good practices not only look at the company's operations, but the company's entire value chain and supply chain. And that's because it impacts the company's not only reputation, but costs, both of which can have a financial impact. So look at the example of Nestle that got discovered that it had labor abuses deep into its supply chain in the Thai fisheries.
Wow.
It had to promptly move to conduct due diligence and remediate and restore a lot of human rights that were being violated in its supply chain. So there is definitely a focus on the extended supply chain of a company, and not just to tier one, but you have to go all the way through to the entire chain of custody. And at Royal, we source a lot, from aluminum and steel for our ships to bananas to feed our guests, and we source them from all over the world, and sometimes from large sophisticated suppliers, but sometimes those suppliers use their own subcontractors. So we need to do it a whole chain of custody to, let's say, our wild fisheries, as well as farmed fisheries, to make sure that not only are there appropriate labor practices in place, but also that their operations are sustainable, because overfishing has become a significant problem for the degradation of the ocean systems, as well as our ecosystems that impact our not only livelihoods and economies, but also our health.
Interesting. So I want to go back because of that. Obviously, we have the EPA and all that kind of stuff. But, that's been out there for years and whatnot. But so when you look at those vendors, I want to go back to the original question. What framework do you use? Just, or is it just a risk of reputation, or just kind of checking the box, making sure, well, I shouldn't say checking the box, but perhaps it's a framework that the company adopted, or some of the frameworks that Jess mentioned earlier before?
You use a due diligence framework. So for human rights, you have the United Nations Guiding Principles for Business and Human Rights, which, in honor of John Ruggie, who recently passed away, a dear friend of mine, I want to mention how groundbreaking those principles are. Every public and even private company is using those principles throughout the world, which means that you have to have policies, risk management practices, and provide access to remedies to your stakeholders on human rights, potential human rights issues, not only in your operations, but as well as your supply chains. For environmental impacts, you generally conduct environmental impact assessments, but there are also a number of standards, whether it's from the ISO standards or, as I mentioned, certification bodies such as the MSC and the ASC that you can use to test whether your suppliers are adopting the appropriate and responsible social and environmental policies and practices.
Interesting. Thank you. Jess, what are your thoughts on this as well within the supply chain, and or have you seen within the scope of your work going that, direct and indirectly into the company's impact on ESG programs?
I think one of the key questions is just to take a step back at the company level and think through, where do I have the greatest impact? Where should I focus my time and resources to make the largest impact? And sometimes that is from a supply chain perspective. Other times it might be combined with some of your internal operations and thinking through your supply chain. So absolutely agree with the due diligence framework that was mentioned. That's extremely important. But yeah, I think some companies need to really just assess and I do think reputational risk does come into play, because you don't, from that Hershey example, you do not want that to be in the paper. And that can usually be an argument, at least from your sustainability ESG team, to make sure that you're getting the proper approvals and resourcing to make sure that you're able to track and perform the necessary due diligence so that you can avoid that reputational risk and make sure that you're doing the right thing for your company. So yes, I think overall assessing from an impact perspective, and we're seeing this is a connected world, your supply chain absolutely matters.
No, reputational for sure. I mean, we all remember BP and the Gulf a few years back, and how much effort they had to take afterwards to cure that, if they ever did. So
right,
absolutely.
And maybe one thing I'll just mention also. I mean, the people listening to this conversation now, as students, as a potential huge buying power for different consumer products and things, that I would say 10 years ago, it was more consumer product companies that had to have their sustainability reports really clearly articulated online, because the millennials, Gen Z care. I think that continues to be important. Different generations entering the workforce care about what their company does. You care about the products that you're buying. I know I make decisions to purchase products that have, clean chemicals, or that have the appropriate supply chains, that have transparency reporting on their website. So I think we're also seeing that has not only an impact just on the company itself, but on who they can recruit, their customer base, which can translate into revenue and sales as well.
Yeah.
You brought up a good point on generation. Certainly, I mean, it has impacted in other industry, even food industry, beverage, and people eat out more and people eat more conscious, and it's just a fact of generation. That's an excellent point. Rich, any thoughts around supply chains and indirect impact?
Sure. My colleagues here brought up excellent points, so I'm not going to mansplain the same thing. But I think I'll take it from the perspective of transparency. And I remember being at a GreenBiz conference out in Arizona a couple of years ago, where Annie Leonard from Greenpeace was up there and talking. She's just a great speaker. And she said it really well. Why is it my responsibility to determine whether or not the shampoo my 14-year-old daughter uses has endocrine disruptors that could impact her ability to have children later in life? That should not be my responsibility. And so I think what we're talking about here, supply chain, we talked about risk and everything else, I totally agree with. But I think there's two things, transparency, like Nike has sort of their tag. Here's where this product was made. Here are the materials. Here's how we treated the labor, labor force, and so forth. That kind of transparency is becoming increasingly important. As with products, that go on your menus, so food and health and beauty care products, things like that. And the other point I think I'd bring up is this is a great opportunity for ESG leaders to work with different groups across the company, to really pull everybody in, because you can tell when you read an ESG report whether or not ESG is truly integrated across the fabric of a company, or if it's, I don't want to say window dressing, because people work really hard on this, but
right.
Just not integrated, just something that it's almost a compliance exercise, and I have to check it off.
Yeah, that's a great point. I can certainly see that happening. I mean, I'm sure it has happened over the years with cultural diversity when it started. Some companies took the checkbook approach. Other companies have taken a more holistic approach into embedding that into the culture of their business. And you can see clearly the results are totally different when it really comes from the top, as opposed to a matter of, well, I got to check the box on this so I look good. Absolutely.
Yeah. And Carlos, there's a third category, the silent approach. No one is under the radar screen. Look what happened to the silent giant, Exxon. Its board got ousted and replaced. So
great point.
Everyone's
no place to hide.
There is no place to hide.
There's no place. Yeah, no, but in all fairness, I think over the years we always thought this only impacts oil industries, right? But it doesn't. I think we just covered some of the impacts on the supply chain, who you're doing business and what, even shampoo bottles, for Christ's sake. So, I mean, I think at the end of the day, people are paying more attention. I think that's a fact. So let me ask now more into the financial reporting when we get into perhaps SEC registrant, where you have to have an integrated opinion, which always, it also includes internal control. And whether it does or it doesn't, still, the cost of framework is something that private companies use as a framework for internal control. So how do you see, and Jess, I'll start with you. How do you see internal control assessment that a company does being impacted by this, as ESG programs are also at the same time being developed?
Yes. So 10 years ago, again, I mean, we would go in and speak with a sustainability team, ask them for support. If they were reporting 100 million metric tons of carbon emissions, we'd say, okay, can you prove it? And they were like, what? We have to prove that? We just calculated that. So I thought that was all we had to do. So there's been a big learning curve, I think, to get up to speed, to make sure that there is the supporting evidence, that there are there's a process in place for the company to identify risks at the different points of collection so that you can implement controls. It was not a language that was necessarily spoken within the sustainability teams, like it was at the financial level. So that has changed. Now we are definitely speaking with companies, like I mentioned, where finance is already involved with these conversations. So they're starting to ask about controls and where the risks lay, so they can make sure that ESG reporting process is more robust and it has the review on accuracy and completeness included. But we also were working with very mature companies that have been reporting ESG topics for a decade. And we're still doing data quality work with them kind of behind the scenes to make sure that they have a documented process and they've thought through those internal controls. So I think kind of the bottom line is there's a lot of room for improvement. And one of the large catalysts is just because investors have very vocally stated that they are making investment decisions based on non-financial data, ESG data. So some of those large institutional investors like BlackRock are saying, we may not invest in companies that have a poor ESG score. And they've started to do that. They've started to kind of act on what they've said. So that it's one thing to just report something. Now that the whole company's a bit more invested in this ESG information, they need to make sure that it's accurate. And that's where internal controls really come into play. So I think that's a great intersection of this topic for our whole panel discussion today, that finance is absolutely important in the sustainability world. If you can speak both languages, you are very dangerous, which is
No, absolutely. And I believe one of the recent SEC speech was kind of like with regards to that. You got the right hand saying one thing, is the left hand aware of it? And I can, just as a simple example, if a company, discloses that they're going to get rid of, X amount of fleet or X amount of properties, just because of whatever they are, perhaps in a place that they shouldn't be. What does that mean for asset impairment consideration, right? When you're depreciating that asset 30 years out, when you just said to the public that, guess what, we're going to be out by 2025. So that's one of the examples. But as I step back right now, I've had interactions with my clients that, some of them have said, well, the only framework for financial reporting at this point is the contingency framework where, I might get fined by the EPA, but that's just simply not true anymore. At least that has been my experience. So I guess I'll ask Rich, what about on your assessment? Do you dive into internal controls as far as financing, as the metrics that impact eventually the financial reporting perspective at all?
Sure. So in many cases, in many companies, the sort of ESG line and the financial line are still separate and don't really talk to each other very well. There was a piece the WBCSD put out a couple of years ago in collaboration with COSO, talked about the integrated of ESG risks into enterprise risk management. And I find that's a good first step, talking with enterprise risk management, because they filter and work very well with the financial, the chief CFO, I would say, the CFO's office. So I guess step one is helping identify the ESG related risks. And of course, TCFD is a great framework to do that. It's Task Force for Climate-Related Financial Disclosure. But then working with, and just a note on that, by the way, you don't have to have a material ESG risk. The investors are really just saying, do the work and tell me whether or not any of the risks you identify are actually material. It's not saying you have to. If you're a steel company and you say greenhouse gas emissions are not material, maybe you didn't do it right. But you take those risks, work with enterprise risk management, and then facilitate that with the office of the CFO. Because just knocking on the CFO's door and say, hey, I think some of these risks are material, we have to put them in the report, it's not going to go very far. You have to have that sort of multi-stakeholder conversation, because this is new, and new is scary. Pain is a resistance to change. So, typically the CFOs say, well, what do I have to do? Tell me about compliance. And compliance is not just about meeting the letter of the law. It's about meeting and exceeding expectations. So I think having that lens of enterprise risk management and the finance folks really helps understand, yes, I understand what this risk is. I've defined it. It has an owner. There are contingency plans. We're going to have a risk treatment, or we're going to transfer it. We're going to accept it. We're going to seek to mitigate it, exploit it. And then how do we report on it? Just like any other risk. And I think BlackRock did say it well. Look, climate risk is investment risk. And that's all you really need to say to start the conversation.
Yeah, no, absolutely. I think Sylvia touched upon the importance of corporate governance over this. And I think that's where it starts, right? Accounting and finance and even auditors, we always pay attention at the tone at the top, because that is the culture that trickles down. And we do pay significant attention to that, just because that is the culture, that is the environment you set from the top. So it's fair to say that if any company has a corporate oversight that is really paying attention to this, it's fair to say that culture is trickling down. So I'll go for the last question before we go into the Q&A, perhaps. So, and this one is kind of related, at least to the profession of CPAs for the most part. So I'll start with Jess on this one. So, and it seems like you're already doing this. So I'll be interested to know, how does that opinion look? But in any way, do you see, as regulators, whether it's the FASB or AICPA, adopt a formal framework? How do you see this as an attestation requirement, if you will, moving forward for, perhaps companies, because they feel like they want to share this with investors, by an independent opinion or some kind that they are in compliance. Jess?
So there absolutely has been a lot of formalization within those organizations like the AICPA to have a specific sustainability assurance guide. That is something that many of the assurance providers provided feedback on. I know PwC, I kind of led that feedback round to help make that a true sustainability assurance guide. So that is what we would leverage. We operate our assurance standards for ESG under the AICPA. We use that sustainability reporting guide. But because there are so many different environmental and social metrics, we do still have to kind of assess sometimes and see what is the best testing approach based on the way that this metric is collected or reported. In terms of those frameworks requiring any certain information, I'm not sure what that will look like. I mean, I know from a regulation perspective, we are expecting the SEC to likely have a disclosure requirement around carbon emissions, likely scope 1 and scope 2. And there's some buzz around maybe scope 3 would be required, maybe D&I metrics might be required. That would likely be announced in January of 2022 for disclosure in 2023 for companies, so on 2022 data. That would be the first step. So that would just be a disclosure requirement, and then an assurance requirement would follow. And I think many companies, though, are thinking, okay, if the SEC is requiring something for me to disclose something, I want to feel confident about that. And so I want to proactively have an independent review from my auditor just to make sure that I feel really comfortable with that information.
Without a doubt. And actually, personally, I audit financial institutions as well. I see possibly in the future, the SBA making sure that whoever they lend money, they have some sort of program around that and or certification around what they say they're doing to be environmentally conscious.
Right.
Rich, how about you?
Well, as usual, just sort of hit the main subjects. So, I think when it comes to the frameworks, for reporting and attestation, a little bit of a crystal ball about the SEC's expected direction. I'm not sure I see any new laws or really rulemaking. I see a lot of enforcing existing guidance, but adding ESG or non-financial topics to the concept of materiality. So similarly, like when the conflict minerals law came out, the other section 1502 of Dodd-Frank, the SEC didn't tell people you have to use the OECD due diligence guidance. They said you have to use an internationally recognized framework for supply chain due diligence. Of course, there was only one. Similarly, I suspect the SEC may say something about you have to use an internationally recognized framework for understanding climate-related financial risks. Of course, there's only one, TCFD. So I don't know that they'll be very prescriptive, because the SEC's learned about court cases and things like that. They want to have rulemaking that is durable, and just by tightening existing disclosure frameworks and concepts of materiality, I suspect those issues that just pointed out will be picked up, and it's you have to at least if not report or explain, disclose and assure. And the report or explain is a far looser standard. So I do think it'll fall into disclosure and under existing rules versus new rulemaking.
Yeah, absolutely. I do feel, and I could tell you as an auditor, we get very hesitant on opining on something that doesn't really have a framework, because the independent side of things kind of, not that it gets tainted, but it's very difficult to frame, the standard, if you will. And
that's what AUP is for, right?
Yeah, but AUP is whatever you tell me to do, I'll do it, right? So, which is a different story. It goes back to the first question. There's no framework, so can companies at this point pick and choose? And how do we ascertain completeness, right, of the program in a way that is framework? And I think Sylvia mentioned this earlier. Again, I want to go back to the corporate oversight, because that's really where it starts. So once, auditors and perhaps integrated auditors or companies for that matter, they start from the top, operational risk, and then they slice and dice which operational risk eventually are going to have a financial reporting impact, by considering many things, the velocity of the risk, as well as, to some level of extended materiality of it, right? So I think the need for a framework is absolutely necessary, so that perhaps the profession can actually perform, compliance, attestation in a way that is consistent across the board. So
if I could just jump in on that one.
Absolutely.
I do think the profession needs to be careful. I remember when the WEF metrics came out a little over a year ago, there was some really good stuff in there, but a lot of people did come back and say, another framework? Are you kidding me?
Exactly.
So if there's
Very
yet
true.
another framework, I don't think the big four should come together and make another framework. Ideally the rulemaking comes from the SEC, and it's clear and not too ornery that it's going to get immediately sued and tied up in court. The one thing I've learned from my many years serving companies is that companies like to know the rules and have a consistent standard that they can meet. So whatever it might be, if it's loosey-goosey and says, oh, well, pick a framework, and you're going to see reporting all over the place. Whereas if they say, we want you to use greenhouse gas protocol to calculate scope 1 or 2 emissions, and we want it assured to, AICPA standards using FRS, ET 101, whatever. I think while companies may not enjoy the extra work and burden and spending the extra money on the audit fees, they will at least say, at least what you're asking me for is clear. And I know I just read this morning that some of the big private equity firms are coming together to make a reporting standard for their portfolio companies. That's not rulemaking for public companies. It's for their portfolio companies to then share that information with their LPs, with their limited partners. But having yet another group come up with yet another standard, I don't think is the way.
I don't disagree. Absolutely. I think we want to keep it consistent, but we want to keep it simple. Right. Or perhaps to the point, Sylvia, you were going to say something, or?
Nope.
Oh, no, sorry.
Actually,
that's
if I
why,
could add,
that's why we hire people like you guys. out of my realm.
Jess?
I do know that, yes, this is absolutely a pain point for everyone involved with sustainability reporting. If you're the company, the one collecting the data, the assurance provider, and I think the frameworks are listening. And I do believe SASB and GRI are working together to try and find a way to bring their frameworks together and standardize that. It's a challenge because, they have different approaches that they believe are very relevant for setting up those metrics, and how do you then combine it. But hopefully some of the students on this call can just make that happen, join one of those organizations and create that framework we all need.
And maybe it's as simple as modifying the COSO framework, right? It has been modified before. So right. I think the latest one, is 2013. I think, the original one was years before. So it might not be a new one, but rather a revised and improved. So I guess I'll stop here and see if there's any questions for the panel. I'll ask the IT team to kind of confirm that.
All right, we do have a question. Is sustainability and sustainability reporting here to stay, or just a fad?
I hope it's here to stay.
Yeah.
My job relies on
it. I mean, honestly, how would companies be able to go backwards? I think we picked a few companies, already. How would you be able to report less? So, for example, somebody had said, well, aren't you nervous if the SEC comes out with, all you have to report is DE&I statistics and greenhouse gas emissions? Aren't you nervous that clients will drop their entire ESG program and only report on those two things and call it a day? There are a number of stakeholders involved here. There's customers. You have to keep your competitors at bay. So I just look, if COVID didn't kill ESG, nothing's going to.
True.
And I'll just add, maybe sustainability is a fad because it's going to be integrated into business. It would be so great if we didn't even need separate sustainability teams, if that was just part of normal business operations and everything worked together. That would be ideal. If you're having facility managers tracking energy usage and that's all being reported up just to monitor from a cost and savings perspective, that would be fantastic. So that would be the only thing I can think of, is if you truly bring it together to completely incorporate it into your business.
The only thing I would add, and here I have to differ a little bit with my panelist Anne. Jess. That yes, you're right that ESG needs to, the company strives for is full integration into the business and full integration into board and senior management decision making. However, you do need, just like you have a strat planning function, just like you have a financial planning function, you need a sustainability lead that will create the playbook, create the plan, the targets, et cetera, working across the organization to make sure that not only, that everyone is working off of the same playbook, and that there are policies and processes in place to set targets and measure progress against targets, and ultimately create the reports that we're talking about.
Excellent.
So we do have another question. I audit small businesses 5 million and under. What advice do you have for my clients that ask me if they should care and/or do anything with respect to sustainability reporting?
I'm happy to take a first shot at this one, because the company I'm working with now, Alvarez and Marcel, we do work with a lot of portfolio companies, so small $5-10 million companies, and their typical response to ESG is, look, I know it's out there, I know it's important, but we're not publicly traded, so I don't really care about the Larry Finks of the world. And then what usually happens is they get a survey from EcoVadis that says, tell me about your ESG program. And if you don't, we may not do business with you. So you may not have the financial or regulatory pressure, but you're going to have the customer pressure, because as these larger companies continue to evolve their ESG programs, as we already talked about earlier, the supply chain, and as Sylvia said, tier 1, tier 2 suppliers, even deeper, it's going to be increasingly important to them to understand their suppliers and what you're doing. So if you're a small company, you should at least look at what I call the usual suspects in terms of ESG metrics. Measure your carbon footprint. You may not need your auditor to assure it, but at least measure it. Report on your DE&I statistics, your worker health and safety, maybe board level governance, diversity at the board level. We're talking about a half a dozen things. We're not talking about a 50 items. And you can even do a materiality assessment. That's a good first step for any company, regardless of your size, just to understand what the core issues facing you are. And then you're ready to meet your customer needs. Because if you operate under the assumption the customer's always right, then you really should go forward with at least starting an ESG program, regardless of your size.
Absolutely agree. Companies of all sizes are getting those customer requests. If they are not ready, it is a scramble, or worse, you're providing inaccurate information, which you absolutely don't want to do. And then, so I think the other key is just take control of your narrative. No matter the size of the company, you are likely having great efforts. You are likely monitoring your energy usage or water consumption, or you have volunteering events or community engagement. Why not just take charge of that, all of those great things that you're doing, and be able to communicate that effectively? If for nothing or no one else, your employees, so that they're proud of where they work. I think that's always a very important stakeholder. So if the customer side doesn't sway you, maybe your employees and being that better place to work might be a compelling argument.
Yeah, the only thing I would add to those brilliant answers is that whether you call it ESG or sustainability or not, there are so many functional equivalents to ESG or sustainability in your business that you may not know. In the context that we're operating today, we are in some respects operating in a resource constrained or a resource sensitive world, whether it's regarding greenhouse gas emissions, your sources of energy, or water usage, or waste management. All of those things impact your bottom line. I think regardless of a company size, these issues are important to the long-term sustainability of your business.
Without a doubt, and I would also add as a moderator that is just good business. I cannot find a person that would be a client of any company, no matter how small or big, would be. They might not come into your door asking for the ESG program, but the minute they find out that you don't have one or that you don't care, I think that's just off, that's just going to be bad business. Any other questions?
Yes, one more question, and this one's going to be a doozy. For each panelist, what keeps you up at night related to sustainability reporting?
I really want to use the quote I heard once, nothing keeps me up at night. I keep people up at night. But I can't really pull that one for size. It's for me with serving our clients, it's our job is to be connected, informed, and responsive, and staying ahead of these regulations and changes. And there's so much velocity coming out of change that you want to make sure that the advice you're giving will stand the test of time and be useful regardless of what regulatory changes you might pop up.
Jess?
Yeah, I mean, honestly, right now, what's keeping me up at night is just all of the requests that we're getting of companies wanting help with ESG reporting, which is a really great problem to have. This is a problem I've been craving for the last 10 years. So it's not so much a problem. And I think Rich is right. It's probably the biggest challenge I see with ESG reporting is that there's so many changes. It's this constantly evolving area. I feel I have empathy for the companies that are going through this and trying to navigate. So I guess we're just all kind of doing the best that we can, using the best knowledge and insight that we have. And we're on this journey together trying to make a difference. And that's kind of the most important thing.
Sylvia, you can say COVID-19, given that you're in the cruise ship industry, but I'll let you answer that one.
I think actually we all are resting quite comfortably with the safety and health protocols that we've established. We're safer than Main Street, to tell you the truth. We've had a minimal incident rate. No one has gone to the hospital. No one has suffered anything other than symptoms. And we have processes in place to isolate and even, evacuate people out of destinations and take them to back to their home in a safe way. So it has taught us a lot, but I think we're reaping the benefits of that, and we're back to a healthy sailing. In fact, on Sunday, I'm boarding one of our ships in Alaska. But what keeps me up at night, but in a good way, is climate, because we're facing some very strong physical but especially transition risks, which impact our operations and our assets. And so as we look at a fleet of ships that are in operation, and a fleet of ships that are in the process of being developed, we need to look at our existing fleet to determine how they can be retrofitted to adapt to the transitions in technology and fuel and non-renewable energy sources that will help us curtail our emissions. But we also need to figure out what kind of investments or divestments, and these are significant, that we will need to make in order to move into towards a net zero emission ship.
All right, thank you. Just to confirm, that was the last question, or do we have any other questions?
That was the last question.
Awesome. Well, I want to step back and thank all the panelists for providing excellent thought leadership and insight into ESG programs. And I would like to thank also University of Miami for allowing us to be here. And I guess that concludes our session.
Great to be with you all today. Thank you.
Thank you.
Thank you, everyone.
Thanks.